Welcome to The Explainer. Today, we're diving into a really fascinating investment strategy, one that actually thrives when things are a bit uncertain. It's called merger arbitrage. And you know what? It's all about finding an opportunity not before the big news breaks, but in the moments right after. So that leads to a pretty interesting puzzle, right? How on earth can you make a profit from a deal that's already splashed across every headline? You think that once a merger is announced, all the easy money's gone. But what if the real opportunity isn't about knowing a secret, but about playing the waiting game? And that's our first section right there, the arbitrage opportunity. We're going to see how it's all about making money not from secrets, but from the time and, frankly, the nervousness that fills that period I just called the waiting game. Okay, so what exactly is it? Well, to put it simply, merger arbitrage is an investment strategy, and the whole goal is to capture that small but hopefully predictable price gap, what the pros call the spread, between a company's stock price after a deal is announced and the final price the buyer has promised to pay.
Let's make this real. Forget the jargon for a second. Just imagine a big company makes a straightforward cash offer to buy a smaller company. That simple announcement is what kicks this whole thing off.
So the buyer has gone public saying, we will pay 500 rupees per share. But right now, if you look at the stock market, the shares are trading for, say, 485 rupees. So what gives? Why isn't everyone just piling in to buy at 485 to lock in that guaranteed 500? That 15 rupee difference, that is the prize. That's what's known as the arbitrage spread. And it represents the potential profit for an investor. We call them an arbitrageur. If, and it's a big if, the deal actually goes through like they said it would. But look, that spread is not free money. Not at all. It exists for one very simple reason: risk. Because, until all the papers are signed and the deal is officially closed, it could still fall apart. That price gap, that's the market's way of rewarding anyone who's willing to shoulder that uncertainty. All right, let's get out of theory and look at a real-world giant, the massive merger between HDFC Bank and its parent company, HDFC Limited. This thing gives us the perfect anatomy of a mega deal. Just to get a sense of the scale here, we're talking about an all-stock deal valued at around 11 lakh crore rupees. That is just an absolutely mind-boggling number. And to put that number into perspective, this wasn't just a big deal. This was the single largest corporate transaction in the history of India. So as you can imagine, the stakes and the potential arbitrage opportunity were just enormous. So the whole thing gets announced back in April 2022, and boom, the clock starts ticking. For the next year and a half, investors were in that waiting game, a really long, tense period filled with regulatory questions and a ton of uncertainty. And then finally, July 2023, the deal closes, and those patient arbitrageurs got to cash in. And believe me, that waiting period was tense, for some very good reasons. This deal had to clear some massive hurdles. It needed the thumbs up from the Reserve Bank of India, no small thing for a new company this huge. It also needed shareholders from both sides to vote yes, all while the value of the all-stock deal was bouncing around with the market. So how do the pros handle something like this? Honestly, they treat it like a minefield, and they have a really systematic way of figuring out the odds, the probability that a deal will actually make it across the finish line. Professionals tend to sort all that risk into 4 big buckets. First, there's a regulatory risk. Simply, will the government say yes? Second, financing risk. Can the buyer actually get the money together to pay for the deal? Third, shareholder risk. Will the owners of the companies actually approve it? And last, there's this little legal escape hatch called a material adverse change clause. Basically, it lets a buyer walk away if the company they're buying suddenly, falls off a cliff. Which brings us to what I like to call the arbitrageur's playbook. This isn't about gut feelings or hunches. No, this is all about having a system, a set of tools for figuring out just how big of a bet to make. Now, a core idea in this playbook comes from a famous formula called the Kelly criterion. We don't need to get into the heavy math, but the simplified idea is powerful. It basically says that the size of your investment, your position, should be based on your edge, how much the odds are tilted in your favor. It's a really disciplined way to decide how much to risk. So what is this edge? Well, it's actually a pretty simple but powerful calculation. You just take the probability you think the deal has of succeeding and multiply that by how much you'll make. Then you subtract the probability of it failing, multiplied by how much you could lose. What you're left with is the expected value of the bet. It's just a smart way of weighing the upside against the very real downside.
But here's the thing. Even if that formula spits out a beautiful number, the pros never bet the farm on one deal. A key rule of risk management here is to cap any single trade at just 5, maybe 10% of your whole portfolio. In this game, diversifying isn't just a good idea, it's how you survive.
Now, besides having rules for your portfolio, a huge part of managing risk is knowing when to just walk away. And that means learning how to spot the red flags, the early warning signs that a deal might be about to go sideways. And these red flags pop up in a few key areas. On the strategic side, things like a hostile takeover or suddenly another company jumping in with a competing bid, that can cause chaos. Financially, if the company being bought suddenly starts performing poorly, the buyer might get cold feet. And of course, on the regulatory front, unexpected political blowback or long antitrust delays can absolutely kill a deal.
At the end of the day, the arbitrager's job isn't really to guess where the whole stock market is going. Their job is to get one thing right: to accurately price the risk that a single corporate promise will be kept. And that leaves us with one final thought, one question to chew on. What is the right price for a broken promise?